Hi everyone, welcome back to another episode of Centrick Talks Property. Today we are joined by Mark Dueck.
Hello.
Managing Director of Me Financial Services. Really pleased to have him on board today. We've had a lot of questions and queries about mortgages, particularly from the first-time buyer market at the moment. So welcome. Thanks for giving up a bit of your time today, Mark.
Yeah, thanks for having me.
Really appreciate it. So I think mortgages is a huge topic and something we could spend all day chewing over today. But
Yep.
I think for this episode, if we could, I suppose, try and keep it towards first-time buyers, owner-occupiers. We'll touch on a little bit about the pandemic and furlough and how that's affected the mortgage market. And then we can do further episodes later on about buy-to-let investment and help to buy and stuff like that. So do you want to give us just a bit of background maybe about yourself and Me Financial?
Yeah, sure.
Services?
So there's three elements to our business. Predominantly, it's independent whole of market mortgage advice.
Okay.
But we also cover all the protection sides of things, and we can also touch on people's insurance needs. So we try and be a bit of a one-stop shop, but predominantly our flagship is the mortgage side. We are a team of 5, and we have an admin as well. So we're not a big company, but at the same time we're not a one-man band, and we'll sort of help each other out with difficult queries and things like that. We're dotted around the Midlands. So I've got a chap called John, very nice bloke. He's over in the Cotswolds, so he's nice for everyone looking for those holiday homes. But the way it is at the moment, with the lockdown restrictions and things, we're all set up on Zoom, and we pride ourselves on being able to pick things up quickly because we have like a portal that clients can have access to, and give them a little shopping list, and we do everything over Zoom, and they can track their case all the way through. So we're well adapted to the lockdown. I've done Scotland last week. So
brilliant.
So but we've been going for around 2.5 years.
Okay.
Prior to that, I was a broker for another 6 years. And prior to that, I worked for a big high street bank for about 14. But between us, we've probably got about 50 years experience in financial services. So hopefully we know what you need us to know. So.
Yeah, brilliant. Okay. So I think today, if we do a little bit about... a lot of questions we're getting about sort of jargon busting, so all the terms that we use day to day. So if we cover off a bit of that. Okay. And then the age-old question... how much can I afford to borrow, which we get, and I'm sure you get nearly every day. So in terms of jargon busting then, give us a few examples, what are commonly used terms within our industry, or your industry particularly, that might help some people that have never been through the process before.
I think the first big one is the old DIP or MIP.
DIP.
So decision in principle or mortgage in principle. Someone will go and look for a house and see someone like yourself. And then they might be asked if you've got a mortgage in principle or decision in principle.
Or mortgage promise.
A mortgage promise is another good one. Really, they're all badged up pretty much the same way. It is a decision in principle is basically a lender saying we've got a decision. It might not necessarily be the decision you want, but it is a decision, i.e. you want it to be an accept. An agreement in principle just means it's been agreed in principle. So there's no real difference. Basically, it will be, have you approached a lender? Has there been an element of credit scoring or checking by the lender? And have they provisionally said yes, subject to a full application?
A high level overview of affordability, income multiples, that kind of stuff.
Yeah, basically.
And will that give individuals an idea of what they can afford to borrow? So will you say you've got an AIP, a DIP for £200,000 as an example?
Yeah, so sometimes what people do, if they're shopping around and they've seen a couple of properties they're perhaps interested in, but one might be 200,000, another one might be 250, we can approach the lender for the maximum, and if that stacks up, then we know that we can ratchet it down if they manage to get a different price or whatever. The amount they can borrow is a big one. So generally speaking, you can borrow anywhere between 4.5 to 5 times your income. Okay. We'll probably come on to that in a second. I'll get the old loan to value. I'll get the old jargon busting out of the way, and that brings me on to loan to value. There you LTV. So LTV, loan to value. It's basically how much of that value of property that you're looking to buy, how much of the value of the property has a mortgage on it. So if you've got £100,000 mortgage for early morning maths sake, and you've got a £70,000 mortgage against that property, the loan to value is 70%. The main thing you need to think about, and I'm sure people that are listening and they've gone out looking for properties and looking for mortgages. Generally speaking, the lower the loan to value, i.e. the more money you're putting towards it, like the deposit, the lower the interest rate will be, and the more likely you are in most circumstances to be accepted for it, because there's less risk for the lender, old lenders. So generally speaking, you'll need a minimum of 10% deposit at the moment. I mean, that's a big hot topic, which I'm sure will come up again down the line. But 15% is good, and then anything more will make life a bit easier for you. But
so as you step down the loan to value rate, almost the interest rates are more favourable.
Definitely so.
Arrangement fees,
definitely so.
Okay, brilliant. So mortgage promise, DIP, AIP, all very similar.
They're all pretty much the same thing. So some lenders will call them different things. There'll be certain lender that will call it a mortgage promise, like you said. Other lenders will call it an agreement principle. It really varies.
I suppose there's few promises these days.
I don't think anyone wants to promise in this climate.
Absolutely. Okay, brilliant. The other one then, I suppose, bringing us on to minimum deposits, that kind of stuff, which again, people ask, well, how much do I need in terms of savings? And that will come back into loan to value, I assume. But what's out there at the moment? I know at the beginning of the pandemic, 10% deposit options or 90% loan to value options, as we'd phrase them, almost disappeared overnight. What's the appetite from the lenders now on those?
It's getting much better. When lockdown first came in, when it first occurred, we went down, but there's probably hundreds of products at 10% deposit, and it went down to about 6 lenders in the end. Actually, at one stage there was one main high street lender that would do it. It's much better now. Pretty much all of the mainstream lenders, I counted up this morning, it's about 12 mainstream lenders and a fair few other smaller lenders that are offering 10%. So I think that market's certainly getting busier for us.
Brilliant.
There's an element where lenders are getting a bit more comfortable with everything's going on. Lenders are getting a bit better at working in a lockdown environment. You've got the elements of sending out valuers and things, and obviously all the staff being picked up and told to work from home. I think that's working its way through now. But certainly it's not easy to get a 10% mortgage as well. It's not as easy as it perhaps used to be. So there will be further checks. There might be a restriction on a multiple of your salary that you can borrow and things like that. So,
and I again, through some clients that were working with us at the time, lenders were only releasing so much lending on a 10% deal per day, per week, per month.
That was the nightmare period about eight months ago. For sure. It isn't quite as tricky like that. There was a period where with one particular lender, you'd have probably the best part of 2,000 mortgage brokers waking up in the morning, refreshing, trying to get a deal, and get it submitted. We're not quite in that space now. There are a few more lenders, a lot more lenders on the pitch now, where that isn't such a problem.
Good. So 10% offers or deposit loan to value, definitely back in the market. 12 plus options for people, but I suppose to summarise, they're being quite picky or selective on who they're lending that product to.
It's not quite as straightforward. So basically, a lender will want you to have really, really good credit, and they generally want you to have had credit before as well. So you've got a history of paying back finance,
track record of borrowing money.
Exactly, and repaying money is the
key point.
So they normally want you to be squeaky clean, and there may also be restrictions as well on multiples of your salary. So generally it'd be about 4.5 times your income. There'll be some lenders a bit more, a bit less, but there'll be a little bit more of a restriction.
Brilliant. I suppose that brings us on quite nicely to credit score. A lot of questions around how do I know what my credit score is, how do I improve it, and ultimately what sort of score are lenders looking for, how do they view it? Could you give us a bit of insight into that dark art?
I think we've recently put some information out about credit scoring. It's quite a I think there's so much out there about it. It can be very confusing. Because you've got credit scoring, you've got credit history, you've got credit searches, you've got soft footprint, you've got hard footprint. I was going to say soft footprint. People are like, what does that mean? I know. So to summarise, your credit history is there's 3 main credit reference agencies that are used. There's Experian, Equifax, and TransUnion.
Right. Okay.
And every other sort of credit provider, if you like, taps into those. So you might get things like Clear Score and things like that. So the reason I'm mentioning all that I often get first-time buyers coming to us going, well, this one's 900, but this one's 725 and things like that.
Right. Okay.
So to put it simply, if you've got what a lender's looking for is that history that you've paid things back well, and you've paid things back
on time.
Consistently and on time and things like that. But they will also have their own ratings as well. Okay. So they'll also have their own credit score, if you like, where what they will do is they will look at those reports that are at the agencies and they'll pick out what they want from it. So there's other things that are things that won't necessarily be on your credit report that will impact on your application. So, for example, if you've only been working for a company for 3 months, for example, the lender may take a less favourable approach than you've been in your job for about 14 years.
Okay.
So there's lots of different things like that. And that's the disconnect sometimes.
Between a score and what a lender will actually make a decision on.
Exactly. So Equifax can say, I'm on a 999 or whatever. But the lender thinks, well, you've only been there for two months. How do we know that your income's going to be consistent?
Of course, yeah.
So there's things like that, and I suppose part of our job will be picking that apart and understanding how different lenders will appreciate that.
Okay, cool. And if somebody goes on to Experian to check out their credit score and it's subpar, or they've had, like you say, maybe some inconsistency in their track record, what can they do to improve that over? And how long would that need to show for? Would it be another 12 months, 2 years, etc.?
Yeah, high street lenders will basically work on your score, as I said. So to improve your credit score, you can do things like if you've got credit cards, it will if you're using 100% or very high utilization of your credit that you've got,
of your limit,
that can have an impact on your
negative impact.
A negative impact for sure, on your score. So you've probably heard sometimes the recommendation is, if you don't have a credit score, for example, what you might want to do is get yourself a small credit card. Buy your shopping on it and your day-to-day spending on it, and then maybe pay it straight back. Or certainly most of it off every month. And then that can build up your track record that you've been.
Because I've seen that before. People go, well, I've never had credit. I'll have a great credit score. I've never needed a credit card or a car loan or whatever. But actually, that can also be seen as negative because there's no track record.
It is a real shame, and we get it all the time. But a lender will be looking to judge you based on how well you've paid
almost
credit in the
performance
past.
Of credit. Before,
and if you've never had it in the past, it's one of those things. So that's a good thing. The second one is electoral roll. Believe it or not.
Right, okay.
So for those that don't know, if you're on the voters roll at your current address, that will show up on your report. So it shows that you've got roots in the property you're in, I suppose. So generally lenders like to see that.
See how long you've been there, and again some consistency on. I suppose.
Okay.
What sort of, obviously there's a number we've talked about, 7, 8, 900, etc. on that credit score. What's a good score? What's a bad score? Are you able to define that?
It's often when we speak to people, they want to go, what number do I need to be to
what's
get
my
this?
number?
Exactly. It doesn't quite work like that.
Okay.
But if you have a score of, say, poor or very poor, there's going to be things behind that. There'll be adverse issues. So for example, a CCJ, a default, multiple missed payments, they're really going to hit your score. And that will be not what a lender will want to see as well. And to answer your question from earlier, generally speaking, the further in the past that is away from the point of your mortgage application, the better. But that will obviously reflect in your score as well. So obviously if that was like 5 years ago, you would hope that would start filtering through in your score.
I was going to say, because we've had people before that have sort of come applied for a mortgage on a property that we we're selling, and all of a sudden it pops up that they've had a CCJ in the past, and everyone's surprised that that was settled 2 years ago or what have you. So I don't want to spend too long on this topic, but I think it's quite an important one. If someone has had bad credit, almost understanding that could have an impact even after it's settled for a number of years almost.
At the same time, I think it's important to mention that if you have had bad credit as well, so there have been a couple of blips, it's life, it gets in the way. There are lenders that will consider those things. So a lender will either be a credit score based lender, or they will want to just know what's on the report. So for example, there are lenders that we're aware of that that if it say happened 3 years ago, they'll just completely ignore it. So if the adverse happened 3 years ago, or if it happened 2 years ago, they might take a more favourable view on it, and they won't be purely led by the score. But at the same time, those sorts of lenders will want a bigger deposit, so that also might be a hurdle. So
okay, brilliant. I suppose almost a linked topic is the pandemic. If you've been on furlough, again, it will come down to a lender's view. Where's the market at? Where are lenders at in terms of if you've been on furlough in the past, or if you're currently on furlough?
Yeah, generically, if you're on furlough at the moment, a lot of lenders will be ruled out. Most lenders will be ruled out.
Even if that's a flexible one, because there's people are working 50%, 80%.
Yeah, so there are
any form.
There are definitely lenders. There are definitely lenders that will consider it. They normally will want to see an end date, for example, or confirm that you're going to be going back to your role. Others will consider it just based on the fact that you're say for example, if your employer's topping you up, they may consider it as well. There are certainly options, but the options are a lot more limited if you are on furlough at the moment.
Yeah, and I suppose they take all that into consideration, how long you've been there, the company history, etc. as well.
Yeah. If you've been back a month, generally they're happy. So if you've got one pay slip without a furlough payment on it.
Okay, that's good to know.
Generally, most people.
So generally, if you've come back to work for a month or more, hopefully you're back in the running for a mortgage application.
That's normally what a lender will want to see. So at the same time, we've done cases where someone says I'm going to go back in October, and it may have been September when we've looked at it. So what we'll do is we'll keep in touch with the client and get that new pay slip, and then we'll have progressed.
Okay, good. One thing that I think most people, before they if they've never had a mortgage or gone through a mortgage application before, they don't understand what's known as the affordability calculator or exercise. Do you want to give us an overview of what that looks like? What, again, I suppose it's showing lenders what affordability that person has. Yeah,
sure. So where affordability is concerned, as I said, you can generally borrow 4.5 to 5 times your income.
Yeah.
But it's not quite straightforward to that. So somebody who's, say, taking a mortgage out for 30 years would certainly be able to borrow more than somebody who's taken a mortgage out for 3 years, because the monthly payments would be so much more.
Right.
And there's other background issues as well. So if you've got car finance, any credit that you might have, say credit cards, etc., you'll find that will eat into the maximum amount that you can borrow. Certain lenders will build in certain standard of living costs. So, for example, if you're paying a certain amount for electricity and all that sort of stuff, most lenders will consider that as your normal Office of National Statistics type affordability stuff, your day-to-day stuff that's factored into their own criteria. But your loans, your credit cards, and your even childcare can have an impact on the amount that you can borrow.
I was going to say, any mortgage I've ever applied for, it's almost like all the usual stuff: outgoings, credit cards, loans, etc. Then down to how much you spend on clothes a month, a year, food shopping, socializing. So it literally takes in everything that your lifestyle almost.
Some lenders do that. I mean, when you're getting mortgage advice from, say, a broker or any mortgage professional, they will need to understand what your daily living costs are to make sure we're recommending the right thing for you.
Yes. Yeah.
If you've got a very expensive skydiving habit that's costing you £2,000 a month or something like that, then we'd need to factor that in and make sure it's personally affordable.
And maybe life insurance would be a good option then as well.
Maybe, definitely so.
Extreme sports.
That's another day. To put it simply, the more outgoings you've got, potentially the less that you can borrow. Now there are some lenders that will really want to look at the finite detail of what you're spending and everything like that, but your general high street lenders will have an affordability and have a matrix which we will plug into and work it out. The thing that also varies about affordability, which makes it slightly more complicated, is if you've got things like benefits and stuff like that. So, for example, child benefit, depending on the age of your children, some lenders will consider that, some lenders won't consider that. If you've got maintenance from a previous marriage, for example, maybe there's more of those knocking around since lockdown.
Possibly.
Some lenders will consider that, some lenders won't. Other things as well are bonuses, which is a big one. Back before
bonuses
lockdown,
and commissions.
Definitely. So back before lockdown, anything that was considered a variable payment. So if you were on a non-guaranteed commission structure or something like that with your work, a lot of lenders were just, no way, we don't want to consider any of that. They're slowly coming in now if they're seen more consistently enough. But they're all things as well that we're trying to sort of pick apart, because some will take 50% of it, some will take 100% of it, some will take an average of 3 months, 6 months, they will see a year's worth. And there's all these different variables that do make it a bit of a minefield out there at the moment.
Okay. And another one I think we get a lot is self-employed. Quite a challenging one sometimes, depending on how long they've run the business. So again, do you want to give us sort of lenders' appetite on self-employed models?
Yeah, so without lockdown and everything like that, the general way that if you're self-employed, so if you're a sole trader or a partnership for starters, they'll generally base it on 2 years accounts, or maybe 3 years accounts. Some lenders are maybe 1 year accounts. So it really varies. But the marmite, if you like, is 2 years accounts that are looked at and it's averaged out. So with everything that's going on, if your income has dropped in your most current year, lenders will want an explanation for that. They'll want to confirm that it's not COVID based and things like that. But they would likely use your lowest of the last 2 years. On the flip side, a lot of businesses are flourishing right now. So if it's showing us an upwards trend, they'll either average them, or they may even just use the most recent for affordability. So there's lots of things around that. Now, if you're an employee of your own limited company, which is always a hot topic, the amount of conversation I have in a week where I'm speaking to somebody who may have a limited company, like myself, somebody's got a limited company and they're salaried by their own limited company. It isn't as straightforward. If you own more than, say, 25% of the company, which most people would do, it's not as straightforward as this is my salary. They will generally base it on your salary from your accounts and your dividends that you're paid. So your director salary from your accounts, your dividends, what you're paid. They don't care about your pay slip. So lots of people have come to us where they've had bad advice, where they've said, well, what I've done is I've just upped my pay for the last 3 months. 3 months pay slips. A lender's not going to be buying that. They need to see your accounts. On the flip side, if you're not drawing all of your profit from the business as well, there are lenders that will consider your net profit from the business as well. And if all that net profit belongs to you, so you're not drawing out all of your income from the company, that's a good way where a lender will consider your retained profits, which may be higher than what you simply pay yourself. Okay,
cool. And then I think the last point is probably mortgage term. So how long can I take the mortgage over is again a regular question we get.
Generally, it's 3 years to 40 years. 3 years to 40 years. 35 years is pretty standard. Age comes into it as well. Of course, if you're 60, you probably wouldn't have a 40-year mortgage.
So is there a multiple? I heard you could only borrow double the length of the mortgage past your age of retirement or something, or up to your retirement. So if you've got 15 years left until you retire, you could only take up to a 30-year mortgage.
So there's two things we're looking at. We're looking at when the client's retirement age is, or the maximum age that the lender would consider to look at for affordability. And generally, whichever's lower. If you're looking to use their employment income. So if somebody's on a nice £50,000 salary, but they said, I'm definitely going to retire at the age of 65, then we will need to go up to that 65. So the mortgage will need to be paid off before they're 65. Unless there's some sort of evidence of pension income in the background and things like that. So, but generally speaking, 70 is the maximum age to use for employment. But there'll be checks to make sure that's sustainable and things. If you're 70 years old up on a scaffolding or something like that,
of course,
won't be buying that.
Brilliant. Okay, a few quickfire questions to round off then.
They weren't the quickfire questions.
They were the quick. I mean, we could spend literally. There's so many more questions I've got, but I think we're just running out of time. But how has the pandemic affected the mortgage world, and what do you see happening in the next 12 months?
Cool.
Crystal ball time.
Well, talking about self-employed for starters, there are more checks that are generally needed, and there's more checks that are generally needed even if you're employed as well. So it's the lender's looking for sustainability of income. So if you're self-employed, they may start looking at your bank statements, for example, to check that since your last year end, you've still got that level of turnover coming through your business and your income sustainable. They may ask for extra stuff from your accountant and things like that. Obviously, there's the obvious thing about loans, deposit amounts. 5% deposits are pretty much, they're not around at all at the moment, unless you have some sort of family support, which perhaps check on it. We'll talk about in another.
So possibly see those creeping back in.
I would like to think so. I would like to think so, but I don't think that's going to be happening imminently. I think we're going to have to see what happens after all of the schemes happened. You know, there's potentials of redundancies and things like that. I think the lenders have just started dipping their toe back into 10% now and getting comfortable with that. I think anything more
95% might be a step too far from
I'd love
right
to think
now.
so, but I think I'm not expecting that to come.
I think the spring 2021 is going to be a big part of the year, isn't it? And we'll define how the future looks. Okay, brilliant. And as we are a property agency, we ask people, describe your dream home to us.
Ooh, I like a bit of gardening. Not very good at it. But I like a bit of gardening, so something with a bit of land at the back.
Okay.
Maybe space for a bit of a hot tub, perhaps.
Yeah, absolutely.
I need to be able to afford that for starters, but maybe something like that.
That would be on your credit score, wouldn't it?
Yeah.
Heating that every day.
Exactly.
Yeah.
And a big enough garden where my children can nicely play down the bottom of the garden out of sight.
And you can sip on a gin and tonic in your hot tub.
Well, especially during lockdown, you know, it's. I think everyone's probably struggling with having kids at home and things like that.
Yeah, absolutely.
But we do love them.
Share your pain. Okay, brilliant. Well, thank you very much, Mark, for joining us. Again, we've got lots of other topics to talk with you, so I'm sure you'll be back again.
Yep.
Thanks for watching, everyone. I hope you found that really useful. We certainly did. If you like it, please do give us a like and subscribe. And really keen to hear your comments on any further topics or questions you have for Mark. We can put you guys straight in touch with Mark, no problem at all. So thanks for watching, and we'll see you again.
Thank you.
I can have a sip of water now.
How was that?
Yeah, really good. Could have talked for hours.